Okay, let's unpack this. Welcome back to the deep dive. We're here to cut through the noise of financial headlines, of these big strategic business moves, and really distill all that complex research into the insights you actually need. Today, we are looking at something in fintech that I think signals a really profound shift. It's about how market intelligence is being built, how it's being monetized, especially in these high-growth economies. We're going deep on finance, data intelligence, and venture strategy. Specifically, we're analyzing that $5 million investment by Zerodha.
A giant in India's retail brokerage space.
Exactly, into this stock analytics startup, Tijori Finance.
Right, and the mission today, it's not really just about reporting the number, the investment size. It's about getting to the why. To understand this massive strategic pivot that the investment is actually funding.
Yeah.
We've got sources that detail the startup's new roadmap, which is very high value.
Yeah.
And we can look at the economics that are driving them away from individual investors and towards institutions.
And even get into some of the specific AI tools they're building, which sound incredibly powerful.
Well, I do.
And I think what really makes this stand out, it's not just another venture deal. It's the history here, the existing relationship. Tijori isn't some stranger. They already power the stock analysis for Zerodha's main trading app, Kite.
So this is a deepening of that relationship.
Absolutely. It feels less like simple diversification and a lot more like a vertical integration of a really strategic data asset.
Okay, so let's start with the hard numbers just to set the stage.
Yeah.
The investment is exactly $5 million. It's going to Tijori Finance, a startup out of Bengaluru that's been around since, 2016.
And the crucial part here is Zerodha's motivation, which they've been pretty open about.
They have. Their stated goal is to fund Tijori to, and I'm quoting here, expand its presence in the enterprise segment.
That phrase, enterprise segment, that's really the key to everything here, isn't it?
It is.
Zerodha absolutely dominates the retail investor world in India. So if they're putting money into a partner specifically to push into institutional data, that suggests one of two things. Either they see a massive untapped market, or maybe they feel a need to hedge their bets to not be so reliant on purely transactional retail revenue.
I think it's both, to be honest.
You ca-
Zerodha is always looking for strategic advantages that go beyond just, facilitating trades.
Right.
By strengthening Tijori, they get a bigger say, more influence over the high-end data infrastructure that powers the really big players, the mutual funds, the asset managers, the insurance companies.
That visibility and the potential for future integration, that's got to be invaluable.
It is.
So how's Tijori actually using the cash? The founder, Siddharth Hegde, said the $5 million is for 3 specific areas.
And these areas really confirm that institutional focus you mentioned.
So what are they?
Well, first is building those new enterprise-grade tools, which we'll definitely get into later. Second is scaling up their server infrastructure. And third is just expanding the team. But that server scaling part is really telling.
How so?
Institutional clients, they don't just want data. They need it fast. They need low latency, high frequency access, and they need to be able to run these huge bulk queries all at the same time.
Right. Retail traffic is high volume, sure, but it's a bit more forgiving on speed. A couple of seconds of delay for a chart to refresh isn't the end of the world for a casual investor.
Exactly.
But for an institutional trading desk or a quant model, they need that data pretty much instantaneously. So what kind of technical challenge does that put on a company like Tijori?
It's a complete rebuild of the backbone. You have to have dedicated, high-speed servers, optimized data structures. You need to handle petabytes of data being queried without any lag.
You can't just repurpose the retail setup.
No way. If you want to service professional fund managers, you have to guarantee uptime and speed in a way that retail infrastructure it isn't designed for. Yeah. This investment is clearly paying for that really expensive, high-reliability upgrade.
And they're not starting from scratch. They're making this pivot from a pretty solid retail base. I think the source said about 15,000 paid retail subscribers.
That's right. It's a decent base, but it's clear they're using that success more as a springboard than as, the final destination.
So the retail side proved the tech works.
Precisely. It proved the product market fit. And now they're taking that successful framework and just aiming it at the sector with way, way higher revenue potential, which brings us right to the economics of this whole shift.
Yeah, that pivot from retail volume to enterprise value is really the core of this whole deep dive. Let's contrast the money here, because it explains so much about why a startup with a successful product would suddenly risk such a big change in direction.
It's a pure economic multiplier. It's all driven by stable, high-margin revenue. If you look at the pricing difference in the sources, it's pretty stark.
So for an individual investor, a retail subscription is about what?
It's around Rs 500 a month, but to get that, you need a ton of marketing, a lot of customer service to deal with high churn. It's steady, but the overall revenue is comparatively low.
And then when they step up to the institutional market.
The price just jumps.
Yeah.
For an enterprise client, an asset manager, a fund, you're looking up at the Rs 5,000 per month.
That's a 10x increase minimum.
A 10x increase on the per user price.
Right.
But the real win here is stability. Enterprise contracts are usually annual. That gives them predictable, high-margin, annual recurring revenue ARR. And that's what investors love to see. It's essential for valuation growth.
Is a 10x price jump like that standard for these kinds of high-end data services? Or is Tijori maybe being a little aggressive, kind of leaning on that Zerodha backing?
It's not uncommon, but Tijori is definitely trying to carve out a niche based on their tech, on the speed of their analysis. That's how they justify the premium.
Right. Institutions will pay. They'll pay exponentially more for any tool that gives them even a tiny competitive edge. They're not just buying data, they're buying time and verified insight.
But it's not an easy switch to make.
No, it's a huge challenge. Retail customers, you can get them through self-service websites. Institutional clients, that takes long sales cycles, custom integrations.
Yeah.
You need absolute trust in the data's accuracy.
A good retail platform doesn't just automatically become a good institutional one.
Not at all.
And you can see that difficulty reflected in their product roadmap. This is where it gets really interesting for me. They didn't just throw money at the problem, they reallocated their future development time, which for a tech startup is probably their most valuable resource.
This is the most telling detail in the whole story, I think. We're talking about a hard, quantifiable commitment here. Nearly 70% of Tijori's upcoming product roadmap is now aimed squarely at institutional users.
And the other 30%?
The remaining 30% is just reserved for servicing and, minor improvements for their existing retail investors. Is there a risk there, that 70-30 split? Could that alienate the 15,000 retail users who got them here in the first place? You're basically starving your original base of any real innovation.
It's a calculated risk, for sure. The strategy seems to be maintain the current retail product, use that 30% for upkeep and small fixes.
Well, you pour everything else into the big enterprise tool.
Exactly. The bet is that the high-margin enterprise revenue will grow so fast it'll completely eclipse any potential short-term unhappiness from the retail side. They're sacrificing broad volume for deep, high-value penetration. It's an acceleration play.
Okay, so let's shift focus to what that 70% is actually building.
Yep.
Because this is where that AI edge, that competitive speed really comes into play. What's the flagship tool they're designing to hook these big enterprise customers?
The big one is a tool called Call Monitor. It's AI-driven, and it's designed to solve a really fundamental pain point for professional analysts.
Which is?
The lag time.
Yeah.
The delay between a company disclosing vital information and that information actually being fully analyzed and synthesized.
Okay, so let's walk through the old way of doing things to really get the change here. A company has its quarterly earnings call. What does a standard analyst at a big firm have to do, and how long does it take?
Well, traditionally, an analyst might listen to the call live, sure. But the full analysis, getting the transcript of the Q&A, comparing what management is saying line by line against previous quarters, cross-referencing all of that with legal filings, that all takes time.
A lot of time.
A lot of time. Even with big teams, you're typically looking at a 24 to 48-hour delay before a detailed, structured report is ready for the decision makers.
And in finance, 48 hours is.
An eternity. Absolutely.
So the aha moment with Call Monitor is that it just erases that bottleneck. It can summarize the entire call, including all the nuanced Q&A stuff, within minutes.
Exactly. It uses advanced natural language processing to generate those summaries almost instantly. Think about the time advantage that gives a fund manager who needs to react to something right now.
You're cutting the analysis cycle from 2 days to, 10 minutes?
Something like that. It's a massive advantage.
But a summary is one thing. The sources say it does something else that's even more important for risk analysis.
This is the killer feature. Call Monitor flags inconsistencies. It flags contradictions. It doesn't just transcribe what was said. It cross-references the live comments with historical regulatory filings with past investor decks.
So if a CEO says something really optimistic on the call,
but it contradicts a risk assessment they filed 2 weeks earlier, the tool flags it instantly.
That is a huge risk mitigation tool. For an enterprise investor, that kind of early warning system spotting something a human analyst might miss under pressure That alone is worth the RS 5,000 a month.
It certainly is. The value is in verified speed and sort of automated skepticism. It lets the human analyst focus on strategy, not on transcription and basic fact-checking.
Okay, but we can't forget the 30%. They still have to keep their retail base happy. So what's the key innovation coming for the individual users?
For retail, it's all about convenience. They're rolling out AI-powered alerts. It's about accessibility and removing friction. These alerts deliver real-time updates directly to a user's phone on platforms like WhatsApp, which is, massive in the Indian market.
So that plays right into what a retail user wants, speed and simplicity. Just give me the notification on the app I already checked 20 times a day.
Exactly. Instant updates on corporate filings, on results, on anything that could move the market for a stock you own. It takes the speed of institutional intelligence and just simplifies it for the mass market, keeping people engaged without making them sift through dense regulatory websites themselves. And what's so fascinating when you connect the tech back to the investment is that a tool like Call Monitor can only work if the data architecture underneath it is incredibly solid. So Tijori is using this money to strategically deepen its intelligence layer.
Right. This isn't just about parsing a few PDFs anymore. To get that level of cross-reference insight, they must be pulling in data from all over the place, some of which must be very hard to get. What kind of sources are we talking about beyond the obvious regulatory filings?
Oh, they're going much wider than traditional financial data providers. They have the standard filings and investor presentations, of course, but they're adding all this non-traditional depth. Things like tracking supply chain data, monitoring raw material trends, and of course maintaining these huge databases of historic financials.
Wait, how does a company technically track something like supply chain data or raw material trends and then reliably connect that back to a financial product? That sounds like a monumental data science problem.
It is a huge challenge. They're likely using a mix of techniques, maybe some satellite imagery analysis, scraping public shipping manifests, or even using sentiment analysis on news reports to gauge where raw material prices are going. The challenge isn't just getting the data. It's validating it, making sure it's accurate, and then tying it directly to the performance of a specific public company, all in real time. That takes a very sophisticated team.
So if you connect that level of data aggregation to the bigger picture, what does this whole push mean for the financial data landscape in India? What does it mean for the competition?
Well, the backing from a giant like Zerodha, plus this laser-focused pivot, it immediately positions Tijori as a dominant next-generation data player. They're not just selling tools anymore, they're selling a competitive edge that's rooted in this proprietary data synthesis.
It's a market shift.
It's a fundamental market shift.
Yeah.
It shows that infrastructure and really hyper-rapid data processing are becoming the key differentiators in public markets. For the old guard, the existing data giants, this AI-driven speed is a serious threat.
Because they have to catch up.
They have to. Tijori is coming into their space already validated by the biggest retail brokerage in the country. It forces the incumbents to either speed up their own AI integration or risk losing their high-value clients who simply can't afford to be operating 48 hours behind the curve anymore.
So for you, the learner, this is just a perfect example of targeted strategic growth. You have a company that used its initial retail success to fund and validate this huge high-margin push into the institutional world. And it's all driven by these very specific efficiency-boosting AI tools. They basically found the biggest friction point in the system, that information delay, and they automated a solution for the clients who pay the highest premium for it.
It's a textbook case. Leveraging existing user trust to launch a high-risk, high-reward pivot, all backed by some really focused tech innovation.
Absolutely. So to recap our deep dive here, Zerodha puts $5 million into Tijori Finance, and that money sparks this major strategic shift. It's defined by a huge 70-30 product roadmap split that heavily favors institutional clients.
A pivot driven by the need for that high-margin, predictable recurring revenue.
Exactly. And it's all powered by AI tools like Call Monitor, which gives professional investors a nearly instant cross-referenced analysis edge over the old ways of doing things.
Here's a final sort of provocative thought for you to consider, based on what we've seen in the source material.
Okay.
Given that Tijori is so aggressively aggregating this non-traditional data, we're talking real-time supply chain info, raw material trends, what kind of competitive edge questions does this raise about the future of market intelligence itself?
That's a great question. I mean, if the standard regulatory filing is public information, everyone gets it at the same time. But if a sophisticated tool can combine that filing with verified, real-time supply chain data that either confirms or contradicts what management is claiming, what does that do to the idea of a level playing field?
Right.
What new types of proprietary, non-traditional data could become absolutely essential for a fund manager to just maintain their edge in a market that's becoming hyper-efficient and AI-driven?
Something to mull over as you see more and more of these data companies scale up.
Indeed. We hope this deep dive was useful in providing some context to this major move in fintech.
We'll catch you next time.